The broadcast is now starting. All attendees are in listen-only mode.
Okay, so good morning and welcome to the call today. Today we're going to be talking about the traps for restructuring a small business. I have with me today Mike Haberfield. Mike Haberfield is a CPA. He's been an accountant for many, many years. I met Mike about a year and a half ago, and we got into some interesting conversations because Mike's background is also in marketing, and he's been working with business owners on things like superannuation, business structure, and tax optimization, we'll call it. And so we did have this discussion about structures in business and what they need to be. So I'd like to introduce Mike to the call today. G'day, Mike.
G'day, David. Thanks for having me.
That's a pleasure. Now, during this call, we're going to go through some information on business structure. If anyone has any questions along the way, you'll notice that in the corner of your webinar screen, there is a question box. Please feel free to add those. But really, I suppose I might just get Mike to start off by giving us a bit of his background, or just telling us a bit of, what sort of how he got to where he is today.
Interesting question. I had a number of different positions, working positions in my life. Private sector, or the government sector, even a stint in teaching, even up to tertiary level. But I made a change seems like a couple of decades ago now, because I wanted to be in business for myself, and my strongest suit was in accounting and tax. So we ended up starting our own business, and currently I'm in a boutique partnership business specialising in accounting, taxation, and financial planning, all blended together.
Excellent, excellent. So let's talk a bit about today's topic. One of the things I found with small businesses is, just trying to make the right decision as to which structure to set up my business in. And I know when I started 13 years ago, I was a bit confused as to, what the best way to go was. So let's sort of go into that topic and talk a bit about, what are the different options that people have.
All right. Well, look, I'll just remind all listeners that what we talk about today is basically very general and not to be relied on in their own cases. And if they have any specific requirements, we're happy to discuss them, but not within the seminar today,
Yeah.
Because everything's on a case-by-case basis. But as a general proposition, clearly there are 5 ways that you can structure yourself in business. So we all know of the sole trader position. Everybody who starts a business by themselves, of course, starts as a sole trader, often working from home.
Yeah.
But from there are a number of choices in terms of growth, if you like, and using different structures. The obvious one is a partnership, because you might, in being a sole trader, decide, I don't want to work at home anymore. I'm going to find somebody who shares what I do, and we're going to rent premises and become more of a business.
Yeah.
That's quite a typical transition. Often also, and I understand this is true of many of your clients, we see that the sole trader working by himself, perhaps from home or even from a rented premise, might jump straight into a company, and that's very, very common. Often we see small businesses also structured as discretionary trusts, and then when people who are structuring want to introduce new partners, they may go to something even more complicated, which is a unit trust. So there are the 5 key structures that you might look at in terms of structuring a business.
And look, I suppose anyone who starts a business, the accountant's first question is, which one of these do you want? And I suppose from a cost consideration, really, it's, I suppose, when we go from 1 to 5, 1 is probably the easiest entry level for a small business, lowest cost, and 5 being probably the more complex of the 5. Would that be fair to say?
Look, that is true. Obviously for convenience, it's easier to start as a sole trader. You don't need any special entities, any legal documents, as in the case of a company, and the accounting, of course, and taxation would be simple. Obviously, you spend more money on accounting and taxation as you go through that hierarchy of entities. Yeah. But that's really probably the least important criteria in deciding where you want to slot in between 1 and 5. Let me show you the next slide.
Yeah.
I've got some decision criteria here. Forgetting cost, we'll take cost as being a given.
Okay.
So more importantly, to decide where you want to locate in terms of those 5 choices, perhaps look at these 5 criteria here. So first of all, look at your business turnover. Obviously, if you're a small business, let's call it a micro business, then there's obviously no great need to go chasing a unit trust structure, for example. It's overkill.
Right.
But if you're a small to medium enterprise, then you would be looking at the other examples. For example, a company, or it might be a unit trust, or it could be a company where the shares in the company aren't owned by individuals, but they might be owned by family trusts, for example.
So just going back to that. So when you say small to medium, what size are we talking?
Well, that's a good question. I think the boundaries sort of depend really, but I like to think of small to medium as being typically, say, 1 million to say 4 or 5 million, something like that in terms of turnover. And after that, I think it starts to get pretty large. Yeah,
Yep.
that's right. But look, they're not hard and fast boundaries.
Okay.
Everything's on a case by case basis again.
Yep.
But so clearly the SMEs can look at, they should be looking at other structures like companies and unit trusts. And of course, large is in a category all of its very own. So once you get into that top category of turnover,
Yep.
you get to a point where, first of all, a lot of the business concessions or the taxation concessions that are offered to the small businesses don't exist anymore.
Mm-hmm.
And then it becomes a bit debatable whether using trust, for example, is even appropriate if you're talking a very, very large company. For example, as we know, most businesses that are listed are just listed companies for that reason. Won't go into the details of why, but moving on. So apart from the size of the firm, you've got the issue of ownership and control. Now, it's a common characteristic of people who start their own business that they like to do it because they want to be in control.
Yeah.
But of course, that lends itself well to the sole trader situation. Yeah. However, if you need to bring other people in for various reasons, that's my point 3, for example.
So extra funding.
You're running out of funds and you can't run it by yourself anymore.
Right.
Or it could even be expertise because you might need to bring in some skills that you don't have, or just you've got limited time and need to share time with somebody.
Yeah.
That's a very good reason to consider an alternative structure. The obvious one would be partnership, but you could use a unit trust structure for that as well.
Okay.
Number 4, now this is a very important one, and if you're a lawyer, you probably go to this one first. If you're a sole trader, if anything should go wrong and if any litigation should occur, if you're going to be attacked by perhaps a creditor or perhaps an angry landlord, or it could even be a customer, then obviously you're a sitting duck for a legal suit. There's not much you can do about it. Potentially, you could lose your home. And people try to use companies to limit that liability. And even for that matter, they may use companies acting as trustees for trusts or family trusts, which gives an extra layer of asset protection. So should a legal suit occur, then the suit tends to be limited to the level of the company, and you can often separate your own personal assets away from the business assets.
So by having a structure, you could actually stop someone from taking your home.
You can do, absolutely. You need legal advice on this. It goes beyond just mere accounting advice.
Absolutely, yeah.
But there are steps that you can take to at least limit the damage that could arise in an adverse situation. You probably can't strike it out completely. There's no such thing as striking it out completely.
No.
But if you go along the spectrum, it's better to have some protection than no protection.
Right.
In the last point, number 5, we're looking at taxation. Now, it's interesting that a lot of small business people don't even think of 1 to 4. They go straight to 5, and they say, look, from sole trader, I've got to do better. I can't stand the tax bill. It's killing me.
Yeah.
There must be something that I can do. A typical example in very small business, micro businesses, is husbands and wives splitting up in the income in the form of a partnership.
Okay.
Although often, under today's tax rules, which are pretty tough, that might be inappropriate, but I imagine a lot of people, I know that a lot of people still do it. I'll talk more about that later on when we discuss personal exertion income.
Okay.
But certainly if you're running a business in the sense that it stands alone in its own right, and if you went on a holiday, the business is still making money because there are other people that are running that business.
Yeah.
You have every entitlement under tax law to split that income.
Okay.
And that being the case, you'd want to go beyond just being a sole trader, and you want to look at some other helpful structures like a company.
That's an important point because when we coach business owners, one of the main jobs for a business coach is to actually teach people how to work on their business, not in their business. Now, if they're self-employed, which is typical sole trader, and most people who I meet who start a business generally are highly skilled at something they do.
Yeah.
They get an ABN and they now can trade.
Yes.
Which is great as a sole trader. But now that we're sort of coaching someone, they want to grow and start employing people, the structure needs to change. So for a growing sole trader, what do they need to consider in the restructuring? So what do they need to think about?
Well, if they're a sole trader from a taxation point of view,
Yeah.
if we're talking about income splitting,
Mhm.
all of the profit, of course, falls on them.
Yeah.
And they may want to consider, for example, the idea of, let's say we're talking a $2 million type turnover business.
Mm.
They may have one or two employees that they're bringing on. They can do it as a sole trader, but whatever profit is left over, assuming they're running a true business,
Yes.
will be taxed in their hands.
Right.
And that's going to be quite a high tax bill.
Okay.
So a tax advantage could come about if you restructured, if you're able to restructure in time without triggering a capital gains tax, into, let's say, a company acting as a trustee for a family discretionary trust. Now, the beauty of that arrangement would be that the residual profit that normally would have been taxed in the hands of the sole trader now sits in the trust, where it can then be distributed to not only the principal who started the business, but also to members of his family that might be appropriate taxpayers as well. By that I don't mean children under the children that are at school, for example, because the rules are pretty tough on them. But you might have 18-year-old sons and daughters at university not making much income, or you might have a wife that's at home, or something like, or other low-income members of the family. So that would be a very useful.
Okay. So you could actually, what you're saying is that as a sole trader, once I hit that threshold of tax, so I think it's $70,000 or $80,000, my percentages go up, and I end up in this 48 cents in the dollar bracket.
45 plus Medicare, that's correct.
Right. So at that point in time, I'm paying the maximum tax. That's probably a good time or a good alarm bell to start thinking about the restructure. Now, you mentioned this capital gains issue.
Yeah.
Can you sort of just shed a bit more light on that?
I can, and to help, I might even switch to the next slide too. So we talked about the typical switch, which is to go from sole trader to a company.
Yeah.
We've mentioned that in doing that, why do that? Why do people go from sole trader to company? And just to pick up your question, there's no problem with a sole trader business growing, and all of a sudden that sole trader decides, hell, this is not really suiting me. I'd like to have a company. I'll go through why in a minute.
Yeah.
But you've asked a tax question. The answer to that's quite simple. There is what we call rollover relief in going from sole trader to a company. So even if you grow the business and it's doing really, really well, and it has an arm's length value, and in other words, somebody would be willing to buy it, sure, there's an underlying capital gains tax issue there. If you simply move or transfer the business into a company, as long as you meet the conditions under the Tax Act, there's rollover relief, and you won't necessarily trigger capital gains tax. However, if you were to roll it into another kind of entity, there certainly can be capital gains tax. So to answer your question specifically, timing is very important. If you're going to plan a change, you need to speak to somebody who's professional to decide, what structure you're looking at, whether there is relief or not. So you don't trigger the CGT. And if there's a likelihood that you might trigger a CGT, see your advisor early, because he can take you through the steps to avoid or minimise the amount of CGT if you do need to make that switch.
Right.
But talking about these people who are sole traders going to companies, in my experience, I often advise clients to look at switching, because to have credibility in the marketplace today, if you're just a sole trader working from home, it's not a good look. We see micro businesses with people who aren't even registered for GST. And you've got to ask, how much credibility can you have if you can't organise your affairs, to a certain level?
Yeah.
So I think the first step, even if you are making less than $80,000 a year, I think the first step is you need to have confidence in what you're doing in your business idea, and invest a little bit of money in your structuring. So going to a company can be a good thing, and registering for GST alongside with it is a good thing as well. You're putting your money where your mouth is. You're showing that you're prepared to risk going into business and making something of it. So marketing, when people see you're a company director, that's a form of marketing straight away.
Absolutely.
And you get the automatic advantage of, you've got limited liability as well that goes with it. So it's not a bad step to switch from sole trader to company anyway. But there are a number of disadvantages, and if you're on your own, and if you don't understand how these things work from a tax point of view, you can get in a lot of trouble. I'm going to talk about some of the traps a bit further down, but I'll just highlight them now. For example, there's the director's drawings trap. If there's any practitioners who get to hear this, they'll be having a bit of a giggle right now. They know exactly what I'm talking about. We see it all the time. There's the problem of personal exertion issue. People assume that just because they formed a company, they can now split their profits with everybody. They'll make all the members of their families shareholders in the company, and start handing out dividends left, right, and centre, and avoid paying tax. Not so easy. There's the fact that unfortunately, if you do go to the company as opposed to say a trust,
Yeah.
you lose the general 50% CGT discount. And that can be a problem, particularly when you sell a business. And there's also issues to do with the small business CGT concessions and how they might apply to companies and other structures. And I'll talk about those a little bit later. But David, did I answer your last question?
Yeah, well, I suppose the question was the transition from sole trader and why should they consider restructuring. So you pretty much answered that, and it does look like it is a tax reason, but also a protection reason. And
protection and the marketing theme, credibility of the marketplace as well.
Well, absolutely. Being registered for GST, having a proprietary limited company makes a statement. So you have answered that question.
Well, in that case, let's go to some of the traps then. So the trap number one. Let's have a look at what I mentioned before, which is the director's drawings problem. Well, technically, it's Division 7A in the legislation, but without getting into that, it's a pretty simple proposition. The ATO requires drawings to be treated as a loan and declared as income. Now, let's just break that down into a very simple sentence. All the legislation says is that you can't just take money out of your company willy-nilly and treat it like it's your money. If you don't declare a wage, for example, all you're doing is just taking money out, then in the books of the company, you'll finish up showing up as a loan account. In other words, the company, which is a separate legal entity, has technically lent you money.
Yes.
Now, a loan doesn't sound like income, but under the tax legislation, it is. It'll be just basically branded as a type of income, and it has to be somehow or other dealt with in a tax return. Oh dear, indeed. So what most accountants, including us, try to do when they see this, and unfortunately I've seen some accountants who don't even see it when we get some new clients, but in the event, to the extent that a set of my books arrives at our firm and we have to turn it into a proper set of financial statements and a tax return, to the extent that these excess drawings have been taken out, we reverse that by declaring a director's wage or possibly by declaring a dividend, so we can back out of the loan. And if there's no loan balance, then when we rule off the 30th of June of each year, then you don't worry about it. And to the extent that the person's taken that much money out that you can't even really deal with it because it's going to create such a huge tax impost in the person's personal income tax return, there is a little bit of a way out, which is to enter into an ATO-regulated loan agreement, which is a very strict agreement that which says that you've got to pay back that loan within 7 years based on a strict set of rules about principal and interest.
Right.
The ATO each year specify a benchmark interest rate.
It doesn't necessarily help, does it? Because it means you've got to pay the money back. Now,
it causes cash flow problems. It causes a lot of angst. It causes anxiety.
Yes.
And both for the accountant and for the business person. So, it's a problem. And I often ask myself when I see people that come to us from other firms and they've got a company and they can't handle their company well, I'm thinking, why didn't they go for the solution, which is to use a trust? Because nothing wrong with the company, but the company can act as a trustee, if you like, a non-operating trustee of a trust. And the reason why the trust has been so much of a benefit in this kind of situation is that, strangely, Division 7A for the moment does not actually attack a trust. It's only for companies. So in other words, the business owner who is regarded as a beneficiary under trust law, as a beneficiary, if he takes money out or drawings out of the trust but doesn't pay it back, and we have a balance at the 30th of June being unpaid, that doesn't trigger a Division 7A in itself.
Right. So they can take a drawing out of a trust and it's considered a loan still.
It can still be considered a loan, a beneficiary loan, and there are circumstances where there can be tax issues, but not in a very, very simple trust. So I won't say any more than that because tax does get complex, but trust can actually help you to overcome this trap number one.
So really, just to sum this up, taking directors' drawings out of the company can be a real danger if the structure is incorrect, because it looks like we're taking money out as a loan, but then all of a sudden we're going to have this tax bill or burden at the end, and we're going to have to pay back. In a trust situation, we can actually
avoid that. Yeah, you won't have to worry about the ATO regulated Division 7A style loan agreement in a trust. So in simple, I won't go into any more detail. In simple terms, that actually does work.
Yeah.
How about another trap?
Yeah, let's go.
Move on?
Let's go to trap number
Yeah,
two.
there's plenty of traps. Traps for all of us. So in trap number two, well, this is a very interesting one actually in the area that we're talking about. It's the personal exertion problem.
Yeah.
People get a bit confused in terms of being able to split income. Let's just talk about what that means.
Mm-hmm.
The sole trader makes $100,000. He's got no one to split the income with, so the $100,000 profit sits in his tax return, and he gets taxed on that. End of
Yes.
story. But if that sole trader is in partnership with somebody else,
Mm-hmm.
and the partnership agreement says we'll split profits 50-50, and they make $200,000, $100,000 each, then you split the income up. Okay. Now, as businesses grow and profits grow, tax becomes more of a burden, and we all know that under our progressive income tax, the more income you load on one person, the more tax they pay. To the extent they can split off some of that income and share it with other people, be they spouses, be they business partners, or be they say individual shareholders hanging off a company structure.
Yeah.
You obviously end up saving on tax.
Okay.
But the truth is that not all income can be split in that way, and where you have a sole trader, or even if you have, say, two partners who are both individual contractors, and essentially what they're doing is making money just simply by selling their time. That's considered to be personal exertion.
Right.
Now, that's in a different category altogether than what we call, say, investment income, which can be split. Investment income that might be derived from shares and rent from property, that can be split.
Yes.
And it's a different category, again, from business income. Now, to give you a good example of business income, I'll talk about myself. Now, I've just come back from a holiday, lucky me. And now, I'm not a sole trader. We have a boutique firm of 10 people. So I went away for 2 weeks. But my business firm still made money. It didn't matter that I was there or not there.
Okay.
Everything could be automatic. It's an automatic process that just keeps running like a machine. Now, I didn't want to. I have a business partner, so out of respect to him, I didn't ring up, say, and tell him the weather in Queensland, say, well, I'm not coming back for another 6 weeks. But if I did that, nothing would change in the business. The business would still continue to crank out dollars because we have a machine that actually can do that. Now, that is a high level of organisation that, in my opinion, business owners should actually strive to achieve.
Agree.
Once you get to that point, once you're able to leverage off a business that runs itself as a business owner, then that business machine, which is earning business income, can be split.
Okay, so the distinction here is, even though you're still, when you're here, you're doing personal exertion, it's transferable to someone else within the firm. And so while you're away, there's no change to the income that's coming in.
Well, that's true, but think of it more in terms of the profit and where the profit ultimately goes. So, for example, if I won't give any secrets away as to what my structure is, but let's just assume that I do happen to have some sort of a trust, or even if I had a company and all my shares are owned in my family trust, then the profits from that accounting practice company, would flow to my family trust. Okay. And because I'm actually deriving business income, not personal income, it wasn't income that was made from me selling my time. I sell some of my time, but it's just part of a team. I've got other people. We all sell our time in my firm. There's 10 of us.
Yes.
So because it's a business in its own sense, then the profit that is derived from that business is distributed to the various shareholders. In my case, it might go into my family trust. Now, who's going to take that income in their tax return? Would it be all on me because I'm one of the business owners? No, it's business income, not personal exertion income.
Right.
I can split that with let's say my non-working spouse, my adult university student son studying law in second year who's making very little income, and so on. So instead of me taking all the profit or my share of the profit on my shoulders and paying tax, and maybe at the highest marginal rate, I split it 3 ways between my wife, my son at university, and myself, as an example.
Okay, understand.
Yeah. So the reality is that most self-employed people do generate, unfortunately, personal exertion income.
Yes.
And therefore they're stuck with declaring that as a wage and or dividend. If they've got a company, it'll be a dividend or a combination of both.
Yeah.
One of the areas here which is interesting is that, and practitioners would know about this, we have the notion of a personal services business as opposed to personal services income. I won't go into that in too much detail because it's very technical.
Yep.
But there are rules about whether you are simply a person working for yourself, but ultimately just selling time. Typically, you see people's invoices where they write down on their invoices a number of hours worked by dollar rate. That's a typical giveaway.
Yep.
So all you're really doing is just selling time, but it's your personal exertion that you're making
Gotcha.
money from. Now that doesn't split up very well. In the case of a personal services business as defined by the Tax Act, you get a little bit more freedom in terms of tax deductions, but it's still very limited in terms of whether you are able to split income or not split income. There's a lot of tax office literature on this. There's case law on this as well.
Yep.
And again, look, without going into too much detail because it's a bit of a tough area.
Yep.
I think people who are in business, particularly people who are sole traders or people who are sole traders but using a company, they should speak to an advisor and find out a little bit more about this area and find out whether they can split or whether they can split in the future. I tell my clients in the solution, you should plan to grow your business by learning to leverage off your employees.
Yep.
So along the way, over a time span, you need to bring in an employee in that can share some of the professional work with you, and that'll start to turn your personal exertion business into more of a machine, if you like, a proper business.
Okay.
Yeah.
But the same philosophy that we teach in coaching, and I think the question is, when's that going to happen, and what is the plan to move forward? So it's that transition, I think, from being sole trader, or even like some people will start a proprietary limited company, even though they're a sole trader, knowing that they are going to grow over time.
Yes, that's right.
So it's about having proper planning and making sure that that is the objective, because that will then help with the tax relief.
Look, I 100% agree with you, and I think that's where it's very valuable for small business people to have mentors, accountants, and coaches like yourself, because you can actually paint for them a time horizon, and they're not stuck at a point in time, and they can actually plan to make the changes and not get hit with these traps further down the track.
Yep.
Now, I'm mindful of time, though, because we've got a few more traps to go, so I might just shoot along. Is that okay?
Yeah, please do.
Look, this next one is the selling the business problem, which is an interesting one. We all want to get out of our businesses one day. The idea is, we don't stay in business just for the sake of business. We enjoy it while we do it, but we leverage off our businesses to have a good lifestyle and ultimately to retire.
Yep.
Or maybe we sell a business to start another business. All sorts of reasons. Now, if you've got a company only, a company pays capital gains tax on the sale of the business, but unfortunately, companies are a bit disadvantaged because they don't get the general 50% CGT discount that we all know about when you sell shares, for example, and you only get tax on half or a rental property when you only get tax on half the gain.
Yeah.
So the result in the case of a company is that when you make a sale, you end up actually paying 46.5% tax. In my example, they were talking about a company that sells its business and the gain equals $1 million. So the company is taxed at the company tax rate of 30%.
Yeah.
Hence, the first tranche of tax that's paid to the tax man will be $300,000. Now, the rub here is that in a company, you've got to get the money out of the company, first of all, if you want to be able to enjoy the use of it.
Yes.
Now, how do you get money out of a company? Well, we talked before about the loan problem and the drawings problem. So to get around that, the only way you can take it out is as a dividend.
Right.
So at least it will be a fully franked dividend, but you'll pay the top-up tax.
Yeah.
So you get hit on that. So the second tranche of tax will be $165,000. So you're paying the first $300 from the company, then you'll get taxed on a net basis $165, which adds up to $465. So you made a $1 million capital gain, which is a form of income, and you're paying 46.5% tax on it,
which is huge.
Albeit in two tranches.
Yeah.
So that's a bit of a problem. And if I could just push on, the selling the business continued. Look, there are other concessions because we have the small business concessions, and if your turnover is less than 2 million, we still have an active asset 50% reduction. But if you had a different structure like a trust, for example, not only would you have this 50% active asset reduction, but you'd also still keep the 50% CGT discount. So this is a good example of where trust can be better than.
Okay, so trust will actually allow me to get the 50% discount on the sale of the business. And now, just going back one step, if I've got a company that hasn't got a trust, is it difficult to transition to a company that does have a trust?
That's a good point. So again, this is all timing. If you've got a company and you realise, for example, from today's chat, that trusts do have some advantages over companies, then it comes down to what will it cost me to make that change, particularly what will it cost me from a tax point of view. Now, if you're going from a company to and adding on a trust, there can be some capital gains repercussions.
Right.
Okay, and I'll talk about that in a further trap in a minute. Okay. So let's put that on the side.
Okay.
But just finishing off here, look at the trust situation in my solution, because the tax actually ends up being 23.25%. Here's the reason why. We start with the $1 million sale, gain rather, the capital gain. The trust will enjoy 50% CGT discount, so you're left with 500,000. Okay. Now, assuming that's taxed at the top marginal rate, the effective rate ends up being half of the 46. Of course. Yeah, 23.25%. So it's a hell of a better solution.
Big difference.
A bit, very very big difference.
200 plus thousand.
Well, it's it's twice the tax. That's what it comes out to.
Yeah.
So. I think it's probably quite a little bit of time in me rushing that. I hope your readers weren't too frustrated with me not going through the example.
I think the key message there is that the distinction between having a trust and not having a trust, the distinction between paying capital gains at the full rate or getting the discount is something you need to plan for.
Exactly.
And so with proper tax planning, a person, no matter what situation they're in, be it sole practitioner, just a standard company, they can actually plan for the sale of their business at some time in the next 5 to 20 years. To make sure that they don't sort of get burnt at the last minute.
I think it's almost a coaching thing, Dave, because what we're looking at really here is that don't think of yourself at a point in time. You should really look at a full horizon and understand there's a beginning, there's a middle, and there's an end. So succession planning is as much a part of successful business as planning the start of a business. So it all needs to be brought together, and which means that you can't really put enough of a premium on good coaching and good accounting and taxation advice.
Well, I think like what you've just suggested is I could get an extra 200,000 just from making a smarter decision before I go to sell. So Michael Gerber said it quite well. He always talked about starting with an end in mind and how will the business look when it's finished. And ultimately, everyone will sell their business at some level, right? Because there's a day where you will stop. Now the question is what happens on that day, and that should be the day that we're planning for from the start.
Oh, good. That's a good point. Now, I said I'll put something on the side, and we can now address that. So, trap number 4 is the new structure problem, and we probably whetted some of the listeners' appetites in the sense that they might be thinking, "Oh, look, I've got a company. Is it too late for me to switch to something else?" Or it might be that they're introducing partners and they want to move their business from an existing company and maybe consider using a unit trust structure, or it could be a partnership of different trusts. There's all sorts of possibilities, but the important thing is that if you're now going to go from one structure to a totally different structure, that has the potential to trigger a capital gain, and it could be quite a sizable capital gain. In fact, it could be a prohibitive capital gain and make it very hard to make that shift.
Right.
So the important thing, and it's my second dot point, is that you need to ask yourself: does the business already have an arm's length value? Now, to decide whether it has an arm's length value, you might look at, say, would there be a willing buyer somewhere out there in the real world that would actually buy your business, or is your business so much 100% personal exertion proposition that without you doing the work, there is no business, which means there is no saleable value.
Right.
So often in the early stages, before you've turned your personal exertion, so to speak, into a business, that might be the ideal time to consider a switch, because there may be no one who's prepared to buy you out if it's all based on your personal exertion. Once you're in the new structure, you start putting in employees, it becomes a different proposition. The other thing we look at is the accumulated profit. So we'd inspect your financial statements, and if there's continuing accumulated profits that you're generating, there could be an argument there that there is some arm's length value. And of course, the other thing is, to the extent that you have or you're about to admit a new partner who's going to buy a share of your business, if you've now got someone who objectively is putting money down for a share of the business, that gives a value to the business.
Okay.
So they're all the things that you need to look at in deciding whether there is arm's length value. Now, if there is, then in transferring the business from A to B, from one structure to another, then basically that transfer is deemed to be, if you like, the same as a sale of a business.
Okay, which then triggers CGT.
Which will trigger a CGT, listeners might want to look up the market substitution rule, which is the technical term for it in tax speaks. But I think I made the point without getting too technical. So what's the cure? Well, I think the solution is you plan your business growth. It's all we spoke about earlier. You plan your business growth and restructuring with a good advisor. Often it's not too late if you get in early. But if you've already got some employees, then you're well down the road. It's a good idea to simulate the transfer and work out how much would the capital gains be. And if it's not too much of a shock, you might do it. If it's shocking, may not be worthwhile doing. But
Yeah, so it can be too late. But
it can be too late.
in more cases than not, if a person's in a situation where their personal exertion is generating the income, they could get away with a zero capital gain.
Often we see, in fact, I can't tell you how many times I've been able to transfer in early stage sole trader type structures into a different structure, and we managed to avoid the issue because there was no objective market value.
So then the cost of transfer is really just the cost of setting up the new structure.
Exactly right. That's right. And I'll talk about costs a little bit later on, but
Sure.
I think we're ready for trap number 5, which
Yep.
is the business partner problem. So this is an important one because this is an excellent reason for businesses to consider a new structure. If you think about it, look, it's hard being in business by yourself.
Yep.
And if you want to grow, you need to develop a bit of synergy with other people, be they employees or even peers like partners.
Mm-hmm.
And often in a good arrangement, sparks will fly, sparks of creativity will fly when you start working with other people.
Yeah.
Often people who are in business might want to take a business partner on or a key person on because that person has expertise, or it might be a matter of funding because it's not easy to get bank loans for business, as we all know, particularly without bricks and mortar security. So to the extent that you're looking at growth, sharing with other people may be appropriate. And of course, that in itself is a structuring challenge.
Yep.
We typically see in that arrangement not just simple partnerships, but typically it might be partnerships of trust or partnerships of family trusts that might be considered in that arrangement.
Yep.
Often using a company as a nominee representing that partnership, or it might be a vanilla unit trust.
Mm-hmm.
I won't go into those in too much detail, but things that the listeners can get some information on from their own advisors.
Yep.
But of course, the downside, once you spread ownership, you lose control. So for the control freak who like doing everything themselves, they might find they start arguing, or perhaps they've picked the wrong partner. So you'll have conflict, and of course, the worst possible scenario, you can have dissolution.
Yep.
So not very helpful. So from a legal point of view, we always recommend that when you are sharing decision making in business, you need agreements to be put in place. So partners need partnership agreements, shareholders in companies need shareholders agreements, and unit holders in trusts need unit holders agreements. And a lawyer, more than an accountant, not probably, but absolutely would need to be involved in that. But typical conditions that you would look at in the agreements would be issues like profit sharing, how you take your money out in terms of return on equity versus return on your exertion. And of course, that therein lies a lot of conflict because some people say, look, I do all the work, how come I don't get much money? Other people say, I'll put in all the money, shouldn't I get some sort of return? So there are issues there. Should one party need to leave, you look at stitching in the right of first refusal, giving the remaining partner a chance to buy out, etc. So, look, that's the end of the traps. And mindful of time, and I want to pick up your last question about costs. I'll go to the next slide, which will pick some of that up.
Yeah, sure.
So, the other issues to consider then, pardon me, things like the upfront costs to establish trusts and companies. In my book, they're not really all that expensive. We get pretty good documents for reasonable prices, and you've got to look at the prices being an investment over many years.
So in ballparks, what are we talking? Are we talking?
Well, look, in my firm, for example, we tend to do companies for including registrations like ABN and GST for around $1,300 plus GST, and trusts we get closer to about let's call it $2,000 plus GST, which means you've got a company and a trust in the deal plus some registrations, which we try to make it something that people can jump on board.
Yes.
In other words, not too prohibitive, so they can get going. We're more interested in, in my business, in establishing long-term relationships. So we get them through the gate, so to speak, and then it's all about the planning and getting things right after that.
Yeah, there's an old saying, failing to plan is planning to fail. I'm just listening to this and thinking how many partnerships go south because all good intentions at the start of the partnership, but there was no actual agreement.
Absolutely, .2, correct. Yep. So, where there's more than one person, would obviously recommend that. Then, of course, you've got your ongoing accounting and tax preparation costs, which I won't quote because they can be anything from from $1,500 to thousands of dollars, depending on how big, plus GST, depending on how big
the structures are.
And whether they've got good bookkeeping and so on. You've also got the issue of planning to go from personal exertion to business income.
Yep.
The listeners would have heard my story about my business firm, me showing off, of course, but we all started out in very small practices.
Yeah.
You know, many accountants start out in business just by themselves. They're just sole practitioners,
Absolutely.
and they form partnerships and take on employees, and the businesses get bigger. This is something that this transitioning is important, and I think it needs advice. I think bolting onto a good coach is a good idea as well.
Yeah.
Having a proactive accountant who understands how these things work, who can reinforce that advice, is a big part of it.
Great.
And of course, the transition, once you get, we're talking about going from sole trader to SME, small to medium, but what about small to medium to large? And then, of course, you've got to look at other issues, which we won't go into today. So, look, if I could just finish off, unless you want to jump in now, Dave, with anything.
Yeah, look, I think you've covered most points, but I suppose the core message that we've got here is that there are stages that a business goes through in its growth, and what looks good at the start all of a sudden becomes not the right size for the next stage of the business. So it really requires a business owner to be asking their accountant to review every year.
Yep.
And say, okay, let's talk about the future of the business, where it's going, what's the appropriate structure now.
Yep.
Because having to make this decision after the horse is bolted can be very expensive from what you've just explained.
Indeed.
And really from what you've also described, it's actually not that expensive to do as part of the planning process. So, you know, I'm big on teaching people how to work on their business, not in their business. I'm big on people having a strategic plan that's 5 or 10 years in length. Now, if you share that with your accountant, then they can make sure that the structure is appropriate at the appropriate time. So I think you've covered most of that pretty well.
That's well put. Can I just put one more slide on?
Yes.
I just want to show the listeners. So in my business firm, we have a bit of an approach whereby we see the business in the centre. We try to help our business clients by helping them to understand their business and develop their business.
Yeah.
You'll notice that I've got arrows where we're leveraging out of business wealth into the other kinds of wealth. So we talk about retirement wealth and lifestyle wealth. So as I said earlier on today, we're in business because we enjoy business and we like the freedom and the control that it gives us in our lives. But to what end? And a big part of it, of course, is that we want to use it to build up funds for our ultimate retirement. But we also want to have an enjoyable lifestyle as well.
Fantastic.
And in my firm, we have a motto, if you like. It's our logo, and that is that MG will measure, create, and protect your wealth. And each of those, in that grid there, you can see that we measure all three wealths, and we can assist you in creating 3 different kinds of wealth, and we can even assist you in protecting that wealth. But interestingly, because today was all about structure, I've put in red in the relevant boxes where structure selection can actually be a contributor. And you can see it's quite important because out of 9 boxes, there's 5 boxes where we could talk about selecting some sort of structure, which can make a big contribution to improving your business wealth and your retirement wealth and your lifestyle wealth. So that's just to give the listeners an opportunity to understand that at MG we have a bit of a philosophy, and we're happy to at another different situation to go into more detail on that.
Look, it is pretty important too, Mike. I mean, one of the things I often say to business owners is the business is usually a conduit. It's a means to an end. Now, a lot of people will argue and say, but I love what I do. And we say, that's fantastic. But one day you're going to not be able to do it, or you're not going to have that option. What are you doing to protect yourself into your retirement? So when we start thinking that way, it actually goes outside of the bubble of business only. And even with coaching, we talk about wealth creation. We talk about passive income. And we say, look, it might not be something you want right now. You might love what you do and love speaking to clients, but let's be realistic about what's going on here is that time marches on very quickly. And as you're probably aware, you go into business and a year turns into a day. And, all of a sudden, 10 years down the track, it's like, where did all that time go?
Absolutely.
So unless we plan for this exit, which is going to happen at some point, we just don't know which point, unless we plan for it, we can end up with all sorts of trouble. And so I think there's some valuable points that you've pointed out today. Obviously, anyone who's interested in finding out more can contact you after the webinar. I'll make sure that your details go out with the follow-up, the thank you email.
Thank you.
Other than that, I'd like to thank you very much for your time, your input. I think today's been a really great eye-opener. And without giving specific answers, and I know to do that, you actually need to understand the specific situation.
Yeah.
And so really, anyone who's listening to this call, they're more than welcome to either email myself or yourself to find out more about how they can optimize their tax position, making sure that they're building a business entity that they can either sell or transfer into the future.
Thank you for the opportunity, David.
That's all right. Thanks very much, Mike, and we'll catch up with you soon.